Hi everyone. In this section, we will talk about the purpose and the feature of financial statements. Although we had discussed this aspect briefly in the coverage of the conceptual framework itself, it would be important to re-emphasize upon this aspect again in the light of Ind AS 1, which is of course the presentation of financial statements. Okay. Now think about it like this. Why do we need financial statements, right? We need it for the users. Who can make or who can take, of course, the economic decisions using these financial statements, right? Wherein, of course, we need these statements to be reliable, as well as these should be structured, right? As in, these should be standardized so that people can understand these appropriately. There should not be any, gaps in the formatting. There should not be any conflicts in terms of the way, for example, the statements would appear. There shouldn't be inconsistencies around it, because end of the day, the money of the users is involved in that. That's something which we had, of course, mentioned about in detail as far as the framework was concerned. We just want to kind of take that, in an extended manner. So when I say I'm looking at the purpose of financial statements, the objective of the general purpose financial statements is to provide information about the position, performance, and the cash flows, which is useful to a wide range of users to make economic decisions. That's something which is the key, right? Where you talk about the position, we will look at, of course, the balance sheet, about the assets, liabilities, and equity, right? Talk about the performance, we will look at, of course, the statement of profit or loss. Okay, we will talk about the revenue. We talk about the expenses. Talk about the incomes, for example, right? And the cash flows, of course, is covered through the statement of cash flows, where we refer to how much is the money from operating, financing, and investing activities. Something that we want to see, of course, under the Ind AS 7 framework in detail, right? There's a complete discussion around that. But briefly, we want to highlight that the very idea of preparing the sets of financial statements is to help users make those decisions about their investments or their monies, economic decisions. And that's where the financial statements will provide the information about all these aspects, what we have discussed at length while discussing the framework, right? What is the meaning of an asset? What's the liability? What is equity? What are income and expenses? And then you talk about, of course, the reference to the cash flows. And then you also look at what is that the shareholders in their capacity, okay? As shareholders, as owners are bringing into the business, let's say share capital, and what are they getting back, let's say in form of dividend. So even those details are covered. And this is where something like a new set of financial statement, which I was referring to when we discussed the introduction part, right? The SOCIE, statement of changes in equity, is presented. Okay. Now, all this information along with the disclosures shall assist those users in assessing how is the company's performance and what are the cash flows that the company expects to, let's say, get or pay at what time and what is the certainty thereof. That's something which is a detailed concept which comes into the picture there. Okay. This section we talk about the general features. Again, this is something that we referred to. We want to spend some time at this, in this particular section. Again, we'll talk about the fair presentation part of it. We will discuss also aspects of going concern and accrual. You would remember in the framework, we talked about these as the assumptions, right? The assumptions that we use while preparing the financial statements. We also refer to the materiality part, the consistency part for that matter. Ind AS 1 also discusses the elements of offsetting. It talks about the comparability and, of course, the frequency of reporting and many such attributes that you need to remember while preparing the sets of financial statements. Okay. So when I say I'm looking at the going concern, importantly, we believe that this assumption, right, should always be present when you're preparing the set of financial statements. And if the management believes that this is not appropriate, we talked about the examples of, you would recollect again, the airlines industry in the COVID arena, right? A few companies died. They obviously went under liquidation when I use the word died, right? So we really want to understand, as a preparer of a financial statement, or let's say as an auditor, is the company really expected to survive that far? Okay, so we look at those aspects. The financial statements prepared under Ind AS should be prepared on a going concern basis. Okay, unless the management either intends to liquidate or to cease trading or has no realistic alternative but to do so. Okay, and that is where it's the management responsibility at any point in time whether the business would be able to continue, let's say, in future, and it should cover at least in the next 12 months period from the end of the reporting period. So whenever an entity is preparing its set of financial statements, you project what is the, what is the expectation of company surviving or the business surviving for at least next 12 months time. Okay, and in case the management has a serious concern about whether this going concern assumption is valid, then those uncertainties need to be disclosed. Now, this is a very conceptual aspect, but it could be relevant from an examination standpoint, where you need to obviously kind of explain under a given scenario, if the company is unlikely to meet the going concern assumption, then how it should be addressed, right? And of course, if in case the financial statements are prepared on a realization basis, right? Effectively, we are saying if the company is unable to see the going concern assumption becoming valid, the best valuation that you can give to your assets and liabilities should be on the basis of realization, which is fair value less cost to sell, for example, right? Accrual basis, etc., may not be relevant in this case, right? So whatever is the basis which is used, so the entity should also be disclosing the basis of those, and the basis of preparation of the financial statements and the reasons thereof. All right. Let's take a small example. It says that extracts from the notes to entity XYZ's 31st of March 2019 financial statement. It says that on the basis of management's assessment as on this date, the financial statement has been prepared on the going concern basis. However, management assessment assumes that the government will reintroduce limited plastic import tariff and that the currency exchange will remain constant. On 15th of March 19, the government announced that limited import tariffs will be imposed in 2020, but the government emphasized that the tariff would not be as protective as the 40% tariff in effect before 2000, let's say, cross level. Provided that INR doesn't strengthen, the management projects forecast a 10% tariff would result in entity returning to profitability. And as on 31st of March 19, the entities had net assets of 1,000 rupees. If import tariffs are not imposed, the liabilities could exceed at the end of financial year 1920. So effectively, while they are preparing the financial statements on the going concern basis, they're also highlighting that what are the probable challenges that they may have in case the events which are beyond their control, let's say the government regulations with respect to the import tariff, etc., okay, could go wrong, then probably there could be a risk. But it's all about the assessment, and the company may still want to conclude that the entity, for example, is a going concern, right? It's a conceptual aspect, but again, you use that reference in the previous, the discussion that we did in terms of the management must be able to conclude that the going concern assumption is valid, first point, and in case they see a reason of not being true, then they should disclose the basis of preparation of this financial statement and the reason thereof. That is something that you really want to kind of carry or remember. Okay, accrual basis is the other assumption that we had talked about. Of course, accrual basis is all about, your all financial statements other than the statement of cash flows, other than the cash flow information should be prepared using the accrual basis of accounting, right? On the basis of occurrence, not on the basis of payment or receipt, right? That's where it is your all elements of financial statements would be recognized there, right? The next part is about the materiality and aggregation. You would simply want to apply your judgment. Okay, you want to apply your judgment in assessing what is a material item, and accordingly you would want to, of course, do the aggregation of similar items per se. Okay, uh, there is no clear line defined, for what is exactly materiality. That is normally discussed and agreed upon between the management and auditors, but in all practical cases, we look at some benchmarks. There could be, let's say, a percentage of revenue, maybe 1% or 2%. Let's say 1% or 2% of revenue. It could be a percentage of profits, which could be, let's say, 5% of profits. Or it could also be a percentage of assets, for example. Again, it could be, let's say, 1% of assets, right? There's no clear line around it. There's no reason to believe that these are the stringent lines, but these are the broader, benchmarking used for assessing something which could be material or, let's say, immaterial. So in case something is reflected in the examination, it is expected, by the way, that examination would either give you some clarification. So if I say, for example, there's an item of, or expense item of, let's say, rent costing or amounting 10 lakh rupees clubbed with utilities of, let's say, 5 lakh rupees, right? Making the total utilities as 15 lakh rupees, right? Wherein your total sales are, for example, only for the sake of argument, I'm saying 2 crore rupees, right? Now this 10 lakh rupees as a percentage of 2 crore comes at 5%, right? So which suggests that this is a material item, which means that if you bring this rent as a part of utilities, it is not appropriate, right? It's a material item and a correction has to be done, okay, in the presentation of, let's say, showing this rental as a separate item. You cannot probably aggregate it with, let's say, utilities in this sense. That's how you start understanding the relevance of the word materiality and aggregation, right? But on the other hand, if this were, for the sake of argument, 20 crore rupees, probably, showing this 10 plus 5 together as 15 lakh rupees as a part of utilities, or let's say rent and utilities or other expenses, may not have been significant, may not have been material, and aggregation could have done the job, right? That is something that you want to pick up in terms of the context of what is materiality and aggregation. Okay, this is a similar example that we want to talk about here. It says that ABC Limited is in its financial statements has wrongly classified assets between two categories of tangible assets. Such a wrong classification would not be material if it only impacts two categories. Okay. However, if it would be material if it wrongly classifies a non-current asset to a current asset category. Again, you're talking about the the criticality of the nature of the item also, right? That's where you start looking at the relevance of the word materiality there. Okay. Similarly, it's also mentioned that amount of bad debts or inventory pilferage, the wastages of that, or loss of inventory, which are considered as routine and immaterial by large companies, which is okay for them because they are significantly large company. Now that could be a challenge to be done as far as the same thought process being adopted by smaller companies. So that's why you start looking at it's a so in a way we are saying that materiality is a relative term, right? And that is where we need to be cautious. We need to be very, very cautious about how does somebody look at the materiality as applicable in this scenario. Okay. Now this is a relevant aspect again that we need to talk about and discuss here. Although this would be even more important and would be discussed when we look at specific standards in terms of the coverage. It says that assets and liabilities normally should not be offset. Okay. Assets and liabilities normally should not be offset unless it's required or permitted by Ind AS, and that would also apply to income and expenses the same way. Okay. But then we may also want to understand that the gains, losses, or related expenses arising from the same or similar items are not material. So in case there are some gains or losses or related expenses from the same or similar items, if they are not material, it is okay to offset those, right? But then let's try to understand why this section even requires a discussion, or why is it even relevant from an Ind AS context. Okay, we are saying that there is a let's say tax asset. Okay, but let's say, for example, let's not use this term because it could be more appropriate to use when we discuss, for example, the standard on income taxes. Okay, so let's say I'm referring to foreign exchange gain of 10 crore rupees. All right, so there could be a sale to a customer of some goods, and because of the exchange fluctuations, there's a book profit of 10 crore rupees. Similarly, there is also a purchase of some material from a supplier, again in the foreign currency, and there is a loss of 8 crore rupees. The question is that should it be shown a net gain of 2 crore rupees, or is it appropriate to show 10 separately as a gain and 8 separately as a loss, right? Of course, we understand that the end result is 2 crore positive. That's absolutely fine. But does it even make a difference? Well, that's what we want to talk about, that it makes a huge difference, because the moment you start bringing the 10 crores and 8 crores, people look at these numbers and these inflate your movements within the statement of profit and loss. I mean, these appear to be a huge movement in terms of plus and minus both. Okay, and that can impact the decision making of the users. So what is the appropriate way to deal with that? Okay, well, I don't want to answer it here, that it should be shown net of 2 crores or should be shown 10 and 8 separately. But this is somewhere you need to look at that each standard would suggest, right? Right. It would be reflecting whether such offsetting are permitted to be done or not, right? I think it's okay to bring in the context of something called as, although I think I wanted to wait for the Ind AS on income taxes to be covered later. But when you look at the deferred tax assets, and liabilities, for example, right? Now, these are normally not allowed to be offset, okay, unless they can really be, if they're arising from same source, for example. But if they're at least arising from different sources, right, then we simply would show the deferred tax asset in the asset side and the deferred tax liabilities on the liability side, which probably balloons the balance sheet. But that's the way it is, that's the way it's meant to be, because the Ind AS on income taxes does not allow, does not permit, for that matter, the offsetting in those cases, right? So something which is, again, to be remembered when you are, let's say, preparing the set of financial statements. Okay, let's have a look at this explanation around it. It says that an entity presents gains and losses on disposal of non-current assets, including investment and operating assets, by deducting from the amount of consideration, etc. And they may net a provision, for example, which is built and reimburse, so the provision and the reimbursement, they may also be, netted. So there are multiple examples which exist where the need to, or occasion of, whether the offsetting is there or not is arising. So you need to look at those aspects and apply the judgment whether it is permissible under a particular scenario or it is not permitted there. Okay, let's have a look at an example. It says that XYZ Limited runs an agency business where it acts as a sales agent, okay, for automobile parts distributor and receives commission income for the same. The company contracts sub-agents to whom it pays commission from the income. The question is whether the commission income, a commission expense, can be offset against the commission income earned. Okay, so there's a one source of income arising as a sales agent, right? And similarly, you're looking at, paying some expenses to the parties who are further hired by yourself. Okay, now when you look at this kind of a scenario, okay, you would again use the principle or the recognition framework that an entity should present assets and liabilities or income and expenses unless offsetting is permissible or required by the Ind AS, right? Wherein the substance of the transaction would normally reflect that part. Okay, so in the given case, if a net presentation is made, it would not reflect the substance. And the whole idea, again, bringing this aspect is that where my major source of revenue is commission earned, right? The corresponding, let's say, or the related expenses, commission expenditure, right? So it's as good as my source of sales or revenue, and of course there is a related expense around that. Okay, so there's no product or a good involved, but a service involved, and that is where it would be appropriate to show these as two separate items. Showing the net information would probably jeopardize, would impact severely the decision-making ability of the users, right? So it would be prudent to not offset. It would be prudent to not give the net presentation, but grossly present both the commission received as a part of your, source of income, and also show separately, yeah, your expenses, right? So that would become the commission income would become your gross revenue, and the commission paid would become an expenditure, for example, in your statement of profit and loss, right? So there's no clear defined uh, elements or transactions where we need to where we will say that this has to be necessarily offset, or this is not necessarily offset. It all depends on the circumstances. It all depends on the scenarios and basis that the decision making is done, right? But then, you need to look at, again, are there any references provided by the specific standards or Ind-AS, for example, and then you use those for the basis of arriving at the decision on that. Okay. The next aspect is, again, we talked about it briefly in the framework, the conceptual framework perspective, where you said that you need to make your presentation fairly consistent, as in you can't just change the placing of elements in different accounting periods. So if you're using a particular structure of preparing your balance sheet, P&L, etc., in 1 year, you are expected to have use it in the subsequent years or comparable periods also. Okay, and you follow that consistency, be it your presentation, be it your choice of accounting, for example, and you would retain the same consistency, unless you believe that the change is either required by an Ind-AS or it would result in more appropriate presentation. Now, importantly, this is something which is covered by a specific standard, Ind-AS 8, accounting policies, changes in accounting estimates, and errors. So it's a long name of the standard, right? So we would deal with that separately, right? When we discuss when can you, for example, bring a change in the consistency, right? And it's not only about the presentation, it could also be with respect to the accounting policy. Okay, so in those cases, the changes may be permitted, which are very restricted. And I think one important point that you want to pick up is, if the index itself is asking you to change, you don't have a choice, you have to change that. Okay, so this would be more a mandatory requirement, right? And this would be more of a voluntary requirement. But again, this is subjective. So one needs to be carefully assessing that. When do you believe that it's more appropriate to change? Okay, that is where Ind-AS 8 throws a detailed or gives a detailed information about that. All right. So let's take a small example. It says that a significant acquisition or disposal or a review might suggest that the financial statements may need to be presented differently. There's a company which is operating, which is probably, which has acquired, let's say, another business, or it has sold off one major chunk of the business. So the presentation may require a bit of a change, right? So that could be an argument to bring the change, for example, right? But then that would only be allowed if the change gives information that is reliable and more relevant. That is still, I would not want you to be worried about it. That is covered in detail under Ind-AS 8. So that is the way you want to kind of understand that. But just take a hint that you have a choice to make it, you have the choice to change that in case you believe that this would result in a more reliable and relevant information to the users, right? Or, for example, as I said, that if the Ind-AS want, for example, to change something, you don't have a choice but to follow that straight away. Okay. The frequency of reporting under Ind-AS is that you need to present the complete set of financial statements, including the comparative information, at least annually. And when you say it's annually, we mean to say 1 year, of course. Okay. Unless you believe that you are changing your end of reporting period and presenting information other than 1 year, it could be longer, it could be shorter also, then it should disclose the reason for using that period and the fact that the information is not completely comparable. I mean, imagine you are a company operating, and there are practical scenarios where many businesses in the accounting framework, they have reported their numbers a bit late. Okay. We don't have to worry about which companies, but there could be a possibility that they do not have the complete information available, or there could be some significant change in or a business transformation taking place, or the challenges faced by the businesses are so very specific that they cannot probably complete the preparation of the financial statements in the defined time frame. So there could be very common reasons for having a longer accounting period, right? Similarly, could be very specific reasons for a shorter accounting period as well, right? So whatever those reasons are, those reasons need to be disclosed. And when I say I'm looking at my current year, wherein I have a longer accounting period, for example, right, versus previous year where I have a 1 year accounting period, these are exactly not comparable. Okay, right? So those facts need to be, of course, disclosed as well. All right. Now, this is something that you would expect, for example, to be provided when you look at information, for example, in the set of financial statements. You should have a balance sheet of current year and previous year, P&L of current year and previous year, statement of cash flows, of course, of current year and previous year, statement of changes in equity of current and previous year, related notes, comparable information again for both the years, which is current and the previous year. Okay. Now you start looking at all this information, and when you say that you are preparing that financial statements, you may have a liberty to prepare information for further years also, although it's not mandatory, but you might want to do that and accordingly present the related notes as well. Okay. Very specific aspect, again, Ind AS 8 will discuss that in detail in case there is a change in accounting policy or a retrospective restatement or reclassification, again all driven under Ind AS 8. Then you need to prepare at least 3 balance sheets. Okay, again, not intending to discuss it here. We want to discuss that very specifically under Ind AS 8's context. It says that the entity in that case present 3 balance sheet, which is the current year's balance sheet, previous year's balance sheet, and something called as an opening balance sheet. Okay, that is something which is required to be prepared. All right, that's something which is the expectation of the standard, right? All driven by Ind AS 8 specifically, not by Ind AS 1. Okay, it says that as far as the additional comparative statement is concerned, the entity may present even also, by the way, a third statement of profit or loss. However, in this case, let's say, the entity is not required to prepare a third balance sheet or a statement of cash flow or statement of changes in equity, right? Sometimes a company may wish to present an additional P&L, statement of profit or loss, right? They have a choice to do that, wherein probably you're saying that there are 2 balance sheets, 3 P&Ls, statement of profit or loss, I mean to say that, 2 cash flows, 2 statement of changes in equity, and of course 2 sets of notes. So very categorically, companies may have a choice to even do that, right? And then within the disclosures, that additional statement, with respect to that additional statement, the comparative information, those disclosures or the specific notes also need to be presented in that case. All right, let's have a look at a small example here. It says that Super Limited operates several departmental stores in Chennai, and the company acquires another company in the same line of business in March 2020. For the year ended 31st of March 20, the company accounted for business acquisition under Ind AS 103 on a provisional basis. And this is very much specific to a standard Ind AS 103, which is on business combinations. Okay. Right. We'll be discussing eventually when we discuss the group accounting. So just briefly to understand that there's an acquisition by one company of another company during a particular period. It says that, and when you acquire a business, you may not always have complete information available about that business in detail. Okay, so using something called as a provisional basis. But eventually, the business combination accounting was finalized and the provisionals were updated, and accordingly your comparatives were adjusted. The question is whether the entity should present an opening balance sheet for the year 1st of April 19. Again, as we understand that, although it's a very detailed discussion that we intend to do in the group accounting specifically, as the provisional accounting was done in the current year only, and it does not really impact anything of the previous period. So there is no need to really go back. Okay. So I think you need to remember here that the need to, for example, build in a third set of, let's say, a balance sheet would normally arise when there is something which is happening for earlier accounting period, right? Something where we look at a retrospective kind of an adjustment. Okay. Right. So that's where we need to go back and prepare. And that's where the comparatives can be impacted. But this may not always be the case, like in the given case. That's why the need does not arise. All right. Friends, you want to remember that this is a very specific case which you would be able to appreciate after having learned group accounting specifically, right? There's a reference element. That's the reason why this example is available under the discussion. But let's pick this up, when we have discussed the group accounting, and we would be able to connect with the requirement of the standard in detail there. All right. Fair presentation and compliance with Ind AS. Well, the important point is that we believe, or the Ind AS simply say that in case you are complying with Ind AS, importantly, in case you are complying with Ind AS, the fair presentation is achieved. That is the way you start looking at it. That if you are applying those Ind AS in their spirit, in the way they intend to be built, automatically the fair presentation is meant to have been achieved there. Okay, right? And then in case you are complying with Ind AS, you need to make an explicit and unreserved statement of such compliance. In a way, it's a declaration given by the management that yes, you have taken every step to ensure that while preparing the set of financial statements, you are complying with the, let's say, requirements of the Ind AS there. And that's how you are able to achieve a fair presentation. Okay. Importantly, also, in case there are wrong accounting policies selected by you, okay, for whatever reasons, right? You cannot make them good by giving a disclosure of that. Okay. If there are incorrect accounting policies, the wrong accounting policies adopted by you, and you disclose that yes, you have done so, this is not the way to achieve compliance with Ind AS. Something that you want to remember. Okay. So that is something that you want to take care of. You have to necessarily do the rectification. This is compulsory. You don't have a choice to avoid that part, right? And any which ways, in case there is a compliance with Ind AS which is misleading, then you need to give a detailed disclosure, although it is not expected to be the case in real life. It is going to be a very rare scenario when you expect that you're complying with Ind AS and still not meeting the objective of giving the reliable and relevant information to the users of financial statements. Okay, let's have a look at a small example. It says that the XY Limited has included an explicit and unreserved statement of compliance for the year ended 31st of March 20. The auditors have included a qualification in the report for wrong application of Ind AS in relation to a transaction entered by the company. The question is whether the company is correct in making such compliance statement, right? Now, importantly, you want to remember here is that, right? Company XY has a reason to believe that it has complied with Ind AS and gives a statement to that effect, right? An explicit and unreserved statement that it complies with the Ind AS. However, the auditors have a different view. It could be an interpretational view or a different view in terms of how, for example, in the given case, Ind AS 21 should be applied, right? Now, that does not mean, it does not mean that the entity has failed to comply, right? This could be an important example to understand. It does not mean that the entity has failed to comply with Ind AS, and it may be correctly observed, for example, that the company is, for example, complying with, all the Ind AS. So that's where we say if the management has a genuine reason to believe that it has complied with all the Ind AS, then of course it is allowed to, it is even required to make an explicit and unreserved statement of compliance. That is irrespective of the fact that the auditors are, let's say, not agreeing to that part specifically. Okay, right? I think this is something that we have discussed broadly. It's just a summary of all those statements that we were referring to. We are talking about a balance sheet, a statement of profit or loss, statement of changes in equity, statement of cash flows, disclosures, and in case there's a need, then we are also preparing those comparable financial statements, or even of the earlier periods in case we want to do that, right? So we're essentially talking about at least two sets of all these financial statements, as a part of the coverage there. Okay, and of course, as I said, that if there is a need to go back on an earlier accounting period, there could also be a requirement of a third balance sheet, right? Something called as an opening balance sheet, as we want to refer to that term there. Okay, this is something that we wanted to cover broadly in terms of what all is the objective and purpose of financial statement, what are the features of financial statements, and we talked about, of course, the comparative information and the fair presentation with the and the compliance with the Ind AS, right? The idea of financial statement is to provide information so that people can make economic decisions. We talked about the assumptions of going concern and accrual. Then we refer to materiality and aggregation. We talked about when are you allowed to do offsetting and when it is not permitted otherwise. We refer to the consistency part and the frequency, which is 1 year, for example, here. Comparative information is at least two sets of financial statements, maybe a third balance sheet also, in case we are going for the earlier accounting periods. The fair presentation, in case we are using Ind AS in their spirit, right? That fair presentation objective is meant to be, or automatically meant to have been achieved. Okay. Also importantly, you cannot just use inappropriate accounting policies merely by disclosures. We can't be allowed to do that, right? So, and one important point, if you believe that using Ind AS is resulting in an unfaithful information, which is extremely rare, unlikely, right? I mean, after all, the Ind AS have been prepared by doing a very detailed research to before they become applicable to any entity. So it is unlikely that this could happen. But in case the management has a reason to believe that this is the outcome, then that needs to be disclosed as well. All right. Thank you very much.